When we measure things, we measure them in currencies. So many euros, so many yen, so many dollars. And we think that yardstick is some sort of an objective measure, like a ruler, But actually, it's constantly expanding. It's deceptive. It's not a good measurement tool. And even with stocks and commodity prices, it's not good. Because, for example, when your grandfather, if you were in the U.S., if he built a house, it would have cost him $4,500. And your father built a house here at $45,000. Right now, the median home price is $450,000. Do you get the message? Okay.
Yep.
It's not so much the rise in the value of the house, but the degradation in the money unit. And so that constantly distorts our technical analysis when we look at price charts.
Advanced technical analysis moves the focus away from absolute dollar prices and toward momentum instead, tracking where an asset sits relative to key moving averages, like a 3-week or multi-week benchmark, to build specialized momentum oscillators. This approach separates an asset's underlying trajectory from noise caused by currency swings. Momentum tends to form recognizable patterns that shift or break well before those changes show up on a standard price chart. That makes it a useful leading indicator, giving market participants an early heads up on trend reversals that raw price action alone consistently misses.
Especially if we're dealing with any span of time, like several years. Because, you look at an M2 chart of the Federal Reserve, the money supply chart, it's a lovely parabolic upward explosion. You think, oh, wow, great. Well, it's a junior Weimar Republic, okay? So anyway, how do you get away from that? How can you measure if you're going to have to use a currency to do it? What's the share price worth 10 years ago and now? It's gone up. If it's doubled, have you really made any money? Or is it simply the degradation of the money unit? Well, you can't totally get away from it. But what we do is we have the two variables. One is the currency unit that we measure by, in our case, dollars. And then let's say a stock price. Well, quite often, you'll see a stock that is dormant, maybe for a couple of years, just blah, 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 nothing going on. And you'll see some that are dynamic. And the ones that are more dynamic generate movements in their moving averages. Upward, downward move, and let's say a 50-day average or a 200-day or a 3-quarter average. That tends to give more influence to the asset itself than it does to the money unit. So we take a half a step away in measuring that asset rather than simply looking at its dollar value. And those momentum dynamics, when we oscillate the price of an asset, let's say the ounce of gold, versus a dollar. The factors that we oscillate it, where you take the price of gold and we add it above or below a certain moving average. So let's say we're dealing with a 3-quarter moving average, which adjusts every quarter, okay? Either gold's above it or gold's below it. And you get a different visual picture by not just the dollar value of gold, but the value of gold relative to that moving average. You create an oscillator, which gives you a different visual image that's partly divorced, not totally, from simple measurement by the money unit. Okay, so that's what MSA is about. That's the sort of the intellectual underpinning. And so we use oscillators, where we're oscillating price versus moving averages. If we want a short-term view of a market, like, what may happen in the next month or 2 or 3? We'll look at intermediate type things. We won't look at it versus some long-term average. We'll look at gold versus a 3-week average, for example, or something. And we get a visual picture that quite often is different, starkly different sometimes, from when you look at a price chart. In fact, momentum will build what we call structures, where, just like on a price chart, you've got a trend, and you've got a rally high and a lower rally high and a lower, so you get a downtrend line, let's say. That's a structure. Well, similar structures develop on momentum, but quite often, those structures that develop on momentum will be triggered, will change direction prior to price giving you a warning. that it's about to change direction. So momentum is often a leadership indicator. And that's why we prefer it over price. We treat price technicals as a secondary. I don't notice any difference. It's just more noise, and markets often have noise, where the investors will focus on some attribute of a market or a supposed factor of a market and think that's the be-all and end-all of that market's trends. And it's usually not the case. Quite often there's a bigger, deeper underlying rationale that's driving the market up or down rather than today's headlines. Well, let's take, for example, the stock market in the U.S. A year ago, 2025, January, the market was at a high around, just short of 6,200 on the S&P, I think it was. And they started to drop. Why? Because new president comes in, and he comes in with a new concept that hadn't been brought up before, tariffs. Oh my God, it's the end of the world, And so the market puked into March, April. And of course, the president, being keenly concerned about the stock market, said, we'll have a 90-day pause. And bam, the stock market turned up again. Tariffs are still here, but the market's a lot higher than it was back then if you sold based on tariffs. Now we have the same thing this year. We have the Iran thing. So what happened in March? They dumped on the stock market because all the world's going to end, okay? And then the war's come and gone 5 times, and yet the stock market is still up there, well above where the March sell-off low was. So again, certain factors are that you mentioned that come and go. Let's say the president's comments, for example. They're noise. And therefore you want to try to ignore them. And that's what we try to do at MSA. We're bearish on the stock market broadly. We think that it's making a top, been making a top for about a year. As its tops frequently are, they're very usually expansive for a year or more. And when that March sell-off occurred based on the Iran war, even though we're broadly looking for a top, we said, do not sell into the war news. You'll get skewered. Sure enough, they skewered them. New highs, okay? Similar thing happened. We cautioned about oil. Back in January, oil was a very laggard upturner among commodities. Most commodities have turned up. Our buy signal on Bloomberg occurred in October of last year. Bloomberg Commodity Index then was 165, I think it was about 165, and it has shot up to higher highs since. No, it was 65. Anyway.
Crude oil is a good example of technical mispricing at work. Measured against major equity indexes or precious metals like gold and silver, oil looks remarkably cheap on a historical basis. Short-term headlines and geopolitical events can spike the price temporarily, but the broader multi-year momentum trend was already signaling a structural turn well before the news caught up. When liquidity eventually rotates out of overextended assets, historically undervalued commodities like energy tend to be the beneficiaries. Energy is a clear case of how cross-asset spread analysis can uncover major long-term value buried under short-term noise.
Oil was a laggard on the upside. It only turned up in January, several months after our buy signal on the Bloomberg. And the price then was $65. There was no war. And we said oil's going up, major upturn in process. It'll probably last several years because it was a long-term momentum breakout. You could not see it on a price chart. You could see it on momentum. And sure enough, we started up, and then that war hit. And then we cautioned all of our subscribers, do not buy into the war news because you'll get skewered, just like the people who sold stocks on the war news got skewered. And sure enough, oil hit about 117. It was its actual peak of that rally. A lot of people, no doubt, bought above 100, thinking oil's going to 200-300, the world's going to end, etc. And lo and behold, where did oil pull back to a week or two ago? $67, $2 above our original buy price, which was $65 in January. We cautioned, again, a news story that's transient. It's not going to last forever. And that's not why oil is going to go up ultimately. And it sucked in what? A lot of headline chasers who thought that that story, that transient event, would somehow guide oil forever. And they got skewered. It's very broad. It's not specific. Look at oil versus its own history. Let's take West Texas Intermediate. Right now it's trading 80 or so.
85, yeah.
It was under 70 recently. It was over 90, 100 and so forth. So it's in the middle of that ink. Okay. But if you go back a couple of years in March of 2022, it was 130. And go back a decade or so, it was 140. So even now at $80, looking at its own price history, you could hardly say it's overdone.
For decades, institutional portfolios stuck close to the standard 60-40 split between equities and fixed income. But with major stock indexes hitting historically stretched valuations and central banks still struggling to tame inflation, institutional strategists are rethinking that framework. Several major investment banks are now pushing a 60-20-20 model instead, explicitly building in real assets like gold and broader commodities as core holdings. As smart money gradually rotates out of overheated stock categories, that liquidity is flowing into tangible alternatives. It's being framed as a genuine structural shift in how institutions manage assets, prioritizing capital preservation over reliance on traditional paper assets.
It's a little more than half its price of a decade ago. Okay. Now, when you look at the Bloomberg relative to, let's say, another asset category like the stock market, if you went back 20, 30 years and measured oil and divided into the price of the S&P and expressed that as a spread chart, oil's off the page cheap. It's like something that's splattered, falling out of the back of a truck, and it's laying in the street there. It's so cheap. It's what's the old theme? Buy cheap, buy low, sell high. Well, oil is still low historically by any standard. Its own history relative to other assets, relative to silver, relative to gold, relative to the stock market. So when the central banks create money flow, as they constantly do, look at M2 charts, okay? That creates asset class movement and liquidity flows. Investors ultimately make that decision about, well, they printed the money, where are we going to put it? Well, they really went crazy back in 2008 and 9 because of the stock market debacle then and the failure of banks. And they printed. In fact, they kept interest rates at zero for about 10 of those 15 years since then. But the money supply growth accelerated, and investors decided to put it into the stock market. After all, the S&P had been cut in half. What the heck? It's cheap. Let's buy it. And they've been doing that for 15 years. But history shows that investor flows of liquidity created by central banks doesn't always stay in the same place. Investors ultimately get tired of a given asset and they'll shift to something else. We saw that back like in the late 70s when they gave up on the stock market. It was a total wasteland for a decade. You couldn't make any money. In fact, it was most of the time was negative. But commodities and gold exploded big time during a global recession because investors decided, hey, they're creating the money flow. Where are we going to put it? I'm tired of the stock market. It's not working. Find some other place to go. Right now, we're in a very unique situation because not only do I think the stock market is topping, particularly the U.S. market, which is an extreme bubble, by the way. A lot of stock markets are not bubbles. This one is, more so than it's ever been in history, the U.S. stock market. It used to be an alternative would be what? The T-bond market. If you go back and look at the stock market from 2000 to 2002, the dot-com collapse, or 2007 to 2009, the mortgage crisis, T-bonds were a play. They worked as an alternative asset category. So did gold during that span of time. Those two places were the alternative places to be. And investors simply moved their money over there once they realized that's the place to be. I think that's what's going on now. Is that we're getting the initial shaking of the market where smart money is saying, hey, I'm going to start to distribute out of this bloated category and move a little bit more into the alternatives. The big changes occurred, and we know it. because a lot of CIOs of major banks have said, hey, no longer 60-40 rule, stock market, bond market. It's now 60-20-20.
Yeah, like Morgan Stanley also advises.
Yeah, Morgan Stanley and others have followed him. Yes, that was half a dozen months ago. He was very wise in that observation. I think the percentages are a little low. That's okay, but at least he acknowledged
it's a first step.
Gold is a real asset, and that's. I don't think the gold move is over. I think the pullback is intermediate, not long term, and I think that what we're about to see is further toppling of the stock market. And once that becomes bleeding obvious to the average guy and to the central banks, the central banks will print, even though that's not a mandate, because some of the components of the stock market are mandates in effect, banks, etc. And we analyze the financial and the banking sector. Technically looks quite vulnerable. But gold is a place to be. And so I think things are changing in a big way. And it's an asset class shift. Public sentiment will shift and finally chase things that it should have chased a while ago. I agree, there is a short-term opposite there, and that's because people are still playing the war news, even today. The other day, oil was down sharply. Today, it's up sharply. Why? Because a comment what the Iranians just did and what Trump said he would respond to. So it's like the whole world pins upon that day-to-day shift. There's bigger things underway here. Primarily monetary crisis developed situations. This time around, unlike 2000 to 2002, 2007 to 9, we have a debt crisis involving government debt. We know it's been there in Japan, a crisis where they had the print. That's the phrase the Prime Minister of Japan used. We're going to print, and they have to save their bonds. The U.S. government bond market is in dire straits as well. We analyze it technically, and we argue that the attempt to base the price of the long-term bonds, 30-year bond futures, for example, since 2022, they've tried to hold a given level, and yields have capped at a given level, but it's not going to hold. We're going to pierce through the bottom of that range, and we're going to push the yields through the top of that range, and that's when you're going to start to get public alarm about, oops, that alternative is not an alternative anymore. Instead, it's the problem, not the alternative. What does that leave you with as an alternative? If the stock market's topping, if the bond market is no longer a viable alternative, as admitted by many CIOs, then that leaves basically one broad category: commodities and gold.